I've been spending a lot of time at the moment just really getting clear on my personal investment strategy, particularly for this new phase of the cycle between 2026 and 2030. So in terms of looking at the next 4 years, I think the first and most important thing for me personally as an investor is to look at what could potentially be coming in 2026. Now, I recently bought a report from SQM Research, which looks at 4 central scenarios in the coming year. Effectively, those scenarios range from what most likely will happen to a couple of outliers like worst case scenario and best case scenario. And when we look at the base case, which is effectively based on population growth to continue as it is, maybe a small reduction in interest rates over the year, as well as inflation continuing at its current pace or slightly rising, they're actually forecasting that prices in Sydney could go up by as much as 3 to 6% in 2026. In Melbourne, 4 to 7%, in Brisbane, 10 to 15%, Perth, 12 to 16%, Adelaide having another cracking year at 10 to 14%, and Canberra again at that 3 to 6% mark. So regardless of where I've looked across Australia's leading analysts or banks, all of them are forecasting that every property market in Australia and capital city should be positive in 2026, with some of them leaning on the more conservative side and others being far more aggressive in their predictions for the new year. The next thing, or the second thing that I went and did, is start and look at the state of the Australian economy and the global economy as it stands today. Now, I'll come back to the bigger picture cycle in a moment, but as Australia stands right now, there's a whole bunch of incredible things going for it right now, which make me honestly a combination of super excited as well as super scared about the short-term future. Now, one of the biggest things Australia has going for it at the moment is incredible population growth. In fact, the Australian government has been allowing almost 500,000 new people to come in from overseas for the last 2 years straight. Now, according to the Australian Bureau of Statistics website, they're actually forecasting another 500,000 plus people a year to move into Australia over the next 5 years. Now, what that actually means for the bigger East Coast markets in Australia is that Sydney will be sitting at over almost 6 million people within 5 years. Melbourne will be almost at 7 million people at that time. And the wider Southeast Queensland region, which is Brisbane, Gold Coast, Sunny Coast and Toowoomba, should be sitting at almost 5 million people in that period as well. Now, the result of that much population spread out over an almost 2,500 kilometre radius is the fact that so much of Australia's future infrastructure, as well as income growth, will occur in those 3 markets and those sub-markets or those major regionals that sit around them. Now, another one of the things that I've noticed in Australia at the moment is that there's been a lot of talk about the undersupply of property, especially affordable property in these major metro and regional markets. Now, while this is partially true, as Phil Anderson, who wrote The Secret Life of Real Estate and Banking, there's the normal vacancy rates that we record, which I'll talk to in a moment, and then there's the shadow property market, which is the holiday homes, the Airbnbs, and all of the people that are sitting on 2 or 3 properties, with many of them empty at the moment. Now, between 2023 and 2024, I actually took 6 months off, which is one of the most incredible things that I've ever done in my life. It was a lifelong goal that while my kids were younger, to take them out of school and to travel the country. And what I saw driving around Australia is the opposite of undersupply. In fact, I believe there's centuries, maybe even a millennia of available space for people to build. What I found from driving around the country is there's a few big cities with massive tracts of flat land around them, and then a whole number of smaller or even smaller regional markets around the country. But if we wanted to as a country to solve the current undersupply issues we're facing, then all the government has to do is fast track development, and we can bring on far more supply than the country needs in its current form. Unfortunately, from an affordability perspective, but fortunately from an investment perspective, the Australian government has made development in the country so hard to do and so expensive to do that we are currently controlling supply. And in markets like Sydney and Brisbane, as well as the Sunshine Coast, Gold Coast, Newcastle and Wollongong, we clearly have an undersupply of available properties for rent. But when we look at the likes of Perth and Melbourne, supply is currently meeting demand, and apparently in Perth, there are so many places due to start that we might end up in an oversupplied position shortly down the line. Now, the next thing that I wanted to look at going into 2026 and for the 3 or 4 years beyond is what's going on Australia-wide from an infrastructure spending perspective. Now, we've all heard about the COVID bailout scheme, which is a way to reignite the Australian economy, which has very, very successfully worked to drive unemployment down and to bring people back into high-paying jobs across the country. Now, from having having a little bit of a look out there on Google and some of the different AI platforms, effectively in the financial year ending 2026, the governments around the country and the Australian government will have spent north of $80 billion on infrastructure over that 1 year alone. But what was even more crazy to me is between 2024 and 2029, the infrastructure spend bill across the country is expected to be north of $242 billion, which is obviously clear to see because everywhere you go at the moment, whether it's a capital city or a major regional market, there are roads, rail, metro lines, bus links, and so much going on with the universities and schools across the country, as well as the hospitals as well. Now, another thing that I've learned to keep an eye on as an investor over the last 16 years of my journey has been interest rates. Now, obviously property becomes easier to buy as interest rates come down and more difficult to buy and hold as interest rates go up. Now, when I looked at the longer term history between 1990 and 2024, so effectively a 34-year period, the average variable interest rate in the country sat at about 6.86%. Now, I don't know about you guys, whether it's your own home or your investment properties, but my rates have been slowly sliding down as rates have been cut by the Australian government again, which has been fantastic. And most of my personal retail rates at the moment sit between about 5.2 and 6%. Depending on the structure of the loan. And that's obviously got to do with the LVR, serviceability, which bank you're at, whether it's interest only, principal and interest, whether it's got an offset account, or whether it was bought in a personal name, a company or a trust or a super fund. So obviously there's variables there, but I highly recommend if you haven't looked at your rates in the last year, definitely talk to your broker because a lot of the banks are giving significantly better rates than the ones that you're probably paying right now. Now, another one of the indicators that I like to track short term and longer term is vacancy rates across the country. Now, when I look at SQM's research across the country at the moment, every single capital city in Australia has a vacancy rate below 2%. Now, the long-term history of that is when capital cities or major regional markets or your particular suburb as an investor has a vacancy rate below 2%, that is considered undersupplied. Now, what's interesting right now is 5 of Australia's 8 capital cities right now, including Brisbane, Darwin, Perth, Adelaide, and Hobart have vacancy rates below 1%, which is chronically undersupplied. Now, what I've seen from my experience of buying over $650 million worth of property for myself and my clients over the last 12 years is that as vacancy rates fall and interest rates come down and wages grow, people get to that place where it's like, is it going to be cheaper for me to own a property or rent one? And as we head to that beautiful position where it's actually almost cheaper to own in many of Australia's capital cities again, we'll see people make that decision from renting economy back to an ownership economy, which will drive prices up over the medium term. Now, I think about the position as well in a post-COVID market around building, not just approvals or supply and demand, but the cost of buying land and building product at the moment. Now, I was talking to my father-in-law last night who used to run a building company, and back in the good old days, about 2019 and 2020, I could build a 2-bedroom granny flat in Brisbane for $115,000. But that same product today, depending on which builder you use, is somewhere between $220,000 and $300,000 for the exact same product, just 5 years more down the line. On the flip side, I look at properties that I used to build for myself, and 4-bedroom houses that cost me $200,000 to build back in 2015, 16, 17 would now cost $350,000 to $400,000 to build. Now, that's just not depressing for me, you, and every other investor in Australia, but that is now the reality. And what I'm starting to see in many markets in Australia is the cost of existing houses, particularly in Brisbane as well as Melbourne right now, are way below the cost of replacing them. So when you look at the price of land and the price of building, in many suburbs around these cities right now, we're seeing a $200,000 to $500,000 difference between existing stock and creating the same stock in the same suburb. Now, I've seen that 3 times before over the last 12 years in southeast Queensland, and each time that happens, we see the price of existing stock coming up to meet what brand new product is worth right now. So that is a big opportunity, particularly in the Brisbane and the Melbourne markets over the next 4 years. Now, another thing that I'm always keeping a finger on the pulse of every single month, honestly, and I've done this for most of the last 5 years, is the number of distressed listings out there in the Australian economy. So I'm sure all of you guys remember the hype in the media around this mortgage cliff that was going to happen when people went from 2 or 3% rates to 5 to 7% rates. But what has actually happened has been the complete opposite. So when I look at the distressed listings in Australia right now, from the time of recording this video in late 2025, from the exact same time in late 2024, distressed listings across the country are down by 29.5%. So people have found a way to hang on to their homes, and we have to remember that the Australian government and the Australian banks are very protective of not putting ourselves in a position where we have a car crash or a major crash in the future. And so they will pull down rates so that people can continue to afford, or they'll bring in crazy incentives like they did during the COVID market, where if you were having financial difficulty paying your home loan, you could actually put a 6-month or a 1-year pause on that home loan and give yourself a bit of a breather to continue to move forward with your life. Another thing that I think is really interesting both now and for the next 4 years of not just the Australian but the global economy is you might have heard Trump recently in the media in the last couple of weeks come out with this idea of 50-year home loans. Now, 50-year home loans are new for this stage of this current real estate cycle, but were very, very common 100 years ago or 200 years ago from today. Now, off the back of this, there's a whole bunch of things and a whole new can of worms to open up. Now, immediately after Trump proposed these potential changes to 50-year loans, Boris Johnson in the UK also proposed the same thing, and it won't be long until we start to see some of the major banks in Australia offering that as a product as well. Now, if you think about one of the main pains that we have as homeowners and investors in the country, it's the massive amounts of interest that we have to repay the bank over our 30 or 40 or 50-year loan terms. Now, what a 50-year term ultimately does is, let's say that you've got $1 million worth of debt, and I'm just pulling a number completely out of the air at the moment, but you've got a 5% interest rate. Effectively at a 5% interest rate, on $1 million worth of debt, you're paying $50,000 per year in interest to the bank, and that's on a 30-year loan term. But if you're able to extend the loan term out to 50 years, what it would effectively mean is that instead of paying the $1 million off back to the bank over a 30-year period, you can pay it over a 50-year period, which means your weekly repayments come down or your annual repayments come down as the person with the debt, and the banks extend the profitability on the product that they're offering you over time. Ultimately, all of this boils down to more affordability and the banks to lend average people more money in the future. On top of this, we now have what Ray Dalio from Bridgewater Associates or Bridgewater Capital would call helicopter money. And this is extremely common at this particular stage of the cycle to keep the show on the road. Now, we've seen this after the last GFC, we saw it after COVID. In the past, you would have heard things like the baby bonus or the first home buyers grants, or free stamp duty, or no lender's mortgage insurance, or first home builders grants. But effectively what this helicopter money does is continue to re-stimulate the Australian economy. So the Australian government effectively goes, okay, we'll give you $30,000, for example, to go build your own home, and we won't charge you stamp duty on that home. And what that does is it stimulates the Australian economy, it helps create more construction supply, and it also produces a whole bunch of jobs. And ultimately, by giving that money, they end up with a big portion of that back through tax, through the builder, through you, and through everything else in the future. So I think we're seeing as much helicopter money in the construction economy as we've seen at any point in the last 20 years at the moment, and that is all to stimulate the economy and continue to produce more product as well as keep this thing going. The final thing that I'm seeing at the moment personally, and I'm sure you're seeing the same thing, is gold's been on a tear, silver's been on a tear, the stock markets around the world have been doing pretty well, although despite bumpy, obviously up from a couple of years ago, and crypto obviously again being extremely bumpy, but is up from a couple of years ago as well. Now, what all these things mean is that the average person who's invested in those assets has made money out of thin air. And off the back of that, the sentiment has been good. So we're now working with people that have made an absolute fortune in stocks, crypto, silver, or gold in the last 5 years. And that money is coming back to the safe haven, which is property. Generally speaking, when we look at long-term history, when people feel good, when money's easy to access, when there's plenty of jobs around, when there's good levels of infrastructure, when supply and demand is equal or at a little bit of a dip at the moment like it is in Australia, And when the other markets or the other products in the investment market around the world are relatively stable, we see positive years. And I think the collection of all of these things are setting up for a very, very strong 2026, with maybe a few storms or some major storms on the horizon between 2027 and 2030. And then what we'll see is another incredible opportunity or period for investors globally as we move into a completely new real estate cycle. Now, before I talk about the longer term history and a really simple strategy to actually do extremely well between 2026 and 2030 to set yourself and your family and your children up for long-term freedom and financial freedom, I wanted to discuss the feeling that most of us as investors are going to go through between 2026 and 2030 and what we can expect from the market. Now, what we're already noticing is massive amounts of volatility. You're seeing the Trump tariffs obviously brought the stock market down by 20 to 25%. You're seeing COVID bring the stock market down by 35%. You're seeing all of that stuff have an effect at the moment. You're seeing massive swings in crypto, in gold and silver as people buy and sell and speculate more and more. And we've seen volatility in property as well. So some of the markets went through an incredible push between 2021 and 2023. Then there was that pause period. And now some of the markets like Perth, Brisbane, Melbourne, Darwin, Adelaide look extremely good for 2026 again. Now, that volatility is due to a whole bunch of big factors, some of which I just spoke about a moment ago. But what we're seeing is higher than average uncertainty in the market, as well as higher than average excitement, as well as fear. Now, in these particular parts where a lot of products around the world are fully priced at the moment or are being driven by retail investors and speculation, is just bigger swings, not just in the market, but how we're feeling as investors as well. And as we move through this 26 to 2030 period, based on history, we should have some form of correction in certain markets around the world, which would create more uncertainty, more fear, and for smart people like you, hopefully more excitement as opportunities come up. I think ultimately between 26 and 2030, we'll have two markets. Now, one market is places like Perth, for example, that have gone absolutely ballistic in the last 5 years, and everything has doubled or maybe even tripled in price, and it has smashed its long-term history of performance. And then the direct polarization of that is markets like Melbourne, where in the last 8 years it's taken an absolute bath, and in the last 5 years since COVID it's had an absolute shocker, where people don't like it at the moment, where the media is really negative to it at the moment. And short term, you'll see the likes of Perth and Adelaide continue to pump, where the likes of Melbourne just tick along. But over time, as these markets become unaffordable and the shininess of them wears off, we'll see the money move back to the east coast of Australia, into those areas like Melbourne, Geelong, Bendigo, Ballarat, and the secondary markets of New South Wales like the Central Coast, Wollongong, and Newcastle again. So for those of you out there that are seriously considering buying property in the next few years, and you're obviously considering what's the right idea or what's the right strategy for that, my simple idea for myself personally is really this. I'm in a position at the moment where I've got my own home, and I've got an ability through my income from work to actually go out there and consider buying something. So I know there's a whole bunch of people that can't afford to do something, but if you, like me, are in a position where you're earning 100 to sort of 300K per year plus, and the banks are saying your equity in your home or your investment looks good, or you've got a deposit for your first property, then my simple strategy at the moment is to go out there and buy one property in my own name. Now, for me, that property is probably going to be priced somewhere between about 600K and $1 million, depending on what I ultimately go out there and buy. But regardless of how much I spend or which city in Australia I go and buy that in, FYI, that will either be in Brisbane or Melbourne for me personally. I'm going to go out there and buy a nice big piece of land in an undervalued suburb, close to the city or close to the beach, close to train stations, universities, shopping centres, as well as the best schools in the location. And as you guys know from all of my stuff in the past, I'm a bit of a bottom feeder. I like going to the market that nobody else is talking about before they all get there, which means my short-term return might not be as exciting or as shiny as Perth doing potentially 12 to 16% in 2026, but I'm looking at the 5, 7, 10, 15-year play versus squeezing the last little bit out of a market that's already done 140% in the last 6 years. Now, that would be my first step. My second step is, for the first time in my journey as an investor, I've recently set up a self-managed super fund. Obviously, now I've been working for sort of 20 plus years. I've accumulated a little bit of money in my super, and I've just been talking to my financial advisor, accountant, and mortgage broker. They've also said that I can go out there and either buy one slightly more expensive home worth about 1.2, 1.3 mil, or two cheaper 600K homes. I've personally opted for the easier option to go out there and buy one home in my super fund worth about 1.2, 1.3. What I'm choosing to do there is buy, again, a very affordable market at the bottom of its cycle that has great potential over the next 15 to 20 years before I hit retirement or preservation age, as they call it. But that will be a longer term play, hopefully getting good timing, good capital growth, good tax flow out of what I do there. And then my third step, effectively this idea could be called 3 properties to financial freedom for you or for me, would be to go out there after I've done my super purchase and maybe grab one more outside of super, either through my name or a trust structure, depending on what I can borrow at that time. But again, that would be somewhere like a 600K property or a $1 million property with the intent to buy at the bottom of the market and hold it longer term. So I think there was a lot of dribble in there, and I'm sorry for that. But if I reduce that back, let's say I go out there and I just keep it super simple. If I buy 3 properties today worth $600,000 each, I'm sitting at $1.8 million worth of property value today. If everything goes okay and the market just does 5% a year for me for the next 15 years, that $1.8 million worth of property today, growing by 5% per year, in 15 years' time could be worth as much as $3.6 million. Now, if I went crazy and I bought 3 properties now worth $1 million each, one outside of super, one inside super, one outside of super, then the $3 million today, growing by 5% a year for the next 15 years, the value of those properties could be worth as much as $6 million. Now, regardless if we're buying cheaper properties or slightly more expensive properties, the position that I want to be in and the position I want all of you guys to be in 15 years' time is a place of freedom, of choices, to spend the time doing the things that you love with the people that you love and becoming who you were created to be and the best version of yourself. And so part of doing that is creating financial freedom. And to get to that point in the future where you have that freedom and choices, it's simply about coming back to the present moment, figuring out your next steps, building an incredible team of people that can hold your hand through every step of that journey, and then slowly taking action in a safe way, regardless of if the market's excited or scared over the next 4 years, and effectively confronting that fear and making things happen one step at a time. G'day guys, my name's Ben and I'm the director here at Pumped on Property, and I just want to say a massive thank you for watching our content today. Now, if you're thinking about buying an investment property in the next 3 to 12 months, then the team and I would love to offer you a one-on-one strategy session. In that session, we can talk about exactly where you are right now, where you'd like to be longer term, and we can deeply educate you on the Australian market. And then you can take that information and go and absolutely smash it on your own, or potentially become one of the small number of clients that we work with each week. To book your session, all you have to do is go to www.pumpedonproperty.com and click that book your free strategy session button. But either way, we wish you all the best on your journey as an investor to financial freedom.